Welcome guys, welcome back to my dad's channel. Before we get started, we're going to talk about ketchup and cereal. And it will taste very bad if you actually do it. So don't.
So guys, stay around. Okay, yeah, I hope you enjoyed the intro with my daughter. Now let's get serious and let's see the two stocks for this week. The first one is Heinz company. It's not only Heinz, but it's Kraft Heinz. They were bought a few years back, and the ex-dividend date is on the 25th of November with an annual dividend yield of 5.06%. And the second is going to be Kellogg with ex-dividend date at the end of the month and with a dividend yield of 3.55%, which has quite similar dividend yields as Coca-Cola. And now let's look into the graphs. So for Kraft Heinz, we have a 45% buy and a 45% hold in terms of the market consensus. In terms of valuation, the stock is still 27% undervalued, which is quite good. Will leave us a lot of margin, even with the stocks being quite high at the moment. Let's see how this happens in January or February. I also mentioned this on my previous video. I don't know if the market is going to fall on January, February. Usually there's a normal trend in the market in January, February. The market is going a little bit down. So let's see what's going to happen. Since we have great news in terms of the vaccine, this seems to be exactly the opposite. But this is something that we need to have with some money aside to see if the market goes down, we can reinvest to average our stocks if it needs. Regarding the financial health, the company still have a difference between 5 billion between liabilities and assets. This is a quite healthy company, beside the fact that the performance is not being great in the past 5 years. So as we can see here, the past performance is not being great. Actually, is being quite stable at the moment. We are having here a big growth, but this is due to the elections, as we can see here on the 5 days. If you see this graph at 1 day, we're going to start have a decline. Probably is going down the next few days. These two lines are going to collide, and then we're going to have a inverse trend on the markets. Instead of a bull market, we're going to have a bearish market. In terms of dividends, this company is being paid quarterly with a 5%, as we can see here, on the months of March, June, September, and December. If you look now for Kellogg, Kellogg has a big hold with a 20% of the market saying to buy. The company is still undervalued with a 12% undervalued, which is not so good as Heinz. But the past performance has been quite positive with 13%. Comparing Kellogg with Heinz, they have a 13% growth, which Heinz doesn't have, has been negative in the past 5 years. And the issue here with Kellogg is their liabilities is quite bigger than their assets. So it's a company that we need to have an eye on them to see what is the future growth. And bear in mind that the dividend yield is quite lower than Heinz. So here is the dividend yield. So we have a 3.51% and has been paying quarterly, actually the same as Heinz, with March, June, September, and December. So this is a company where the stock is not growing so fast as the others. If you look to the 5-day stock, is quite stable. I do think they probably go a little bit down. Let's look into the 1 day, and this is going to continue down. You can see here you have a bearish sentiment regarding the Kellogg, but I do believe since we are coming close to the ex-dividend yield, the next week it will increase a bit. So it's one that we need to have an eye as well. It's a nice company to have in your watch list. Of course, if you want to go for higher dividends, I probably recommend Heinz instead of Kellogg, which in terms of payment days is exactly the same thing. Besides the fact the performance of the company is not being great, in terms of the company health, Heinz has more assets than liabilities, which is quite great in terms of future growth. And this probably won't affect the 5% dividend yield that they are paying at the moment. So now let's look into our copy trades simulator. And what I'm going to do is an example. If you copy me, how much you're going to win per month and what is the stocks that's going to affect your monthly payments. So let's have a look. So if you follow me on eToro, you can see all the stocks. I'm going to leave the link on the description if you want to follow me and if you want to copy me. So these are the stocks that I have, between 4% in each one of them. I try to put the same amount in all of them. And what we're going to do is to copy all these values and put in a spreadsheet so I can see how much stocks do I own if I copy in this case myself, and how much I'm going to receive monthly for the amount of value that I'm going to invest. Bear in mind, if I copy this is not going to give me 100% because I have 26% as balance as money in case of there's a crash on the market or some averaging that I need to do. So 25% of my entire investments, it's put apart. So we need to have that in consideration. So let's look into the spreadsheet. So what I have here is my spreadsheet. This is quite similar to the one I've created last week, but in this case it's for copy trading, which I'm going to update the stock at the given time, and here is the percentage that I have on my portfolio, or the person that you're going to copy. So what I've done, copy the percentage that I have in my portfolio. So 0.5%, actually 2.09, 1.5. Okay, so I'm going to copy this as long I have in my portfolio the same thing, and I'm going to repeat this to all the stocks and update my spreadsheet here. In this case, what's going to happen is Facebook and Tesla are two stocks that don't give any dividends. This is what being considered as growing stocks to allow my portfolio to grow. But although when you're copying, you're going to copy this as well. And here it's the example of investment that I'm going to do. So let's say that we invest $200. This is the number of shares that I'm going to buy of each one of them, because you are copying me and you are copying a percentage. Here it's the 75% of my entire portfolio, since the other 25% it's money that's I don't have invested, it's money that I have put apart. And this is the number, or this is the shares of stocks in case you invest $200. So if we invest $500, what's going to happen? This is going to increase the shares. It's going to increase my value market. So here is my investment of 500, and here is the amount that you're going to bring home each month if you do an investment of $500. And you're going to have $23 per year of return, or in this case of dividend yield. So your overall will be around 4.61%, since we're going to have here, it's affecting this percentage because we have you are copying also Facebook and Tesla, but these are two peculiar stocks which are going to allow my portfolio to grow in the next 3 or 6 months, which I intend to sell in a certain time when they are really high, or probably my intention is until August, when the stock's going to be higher next year. Probably we'll see. I had a new investment in MPW. MPW is a REIT light store, but instead of commercial is focused on hospital and healthcare. You need to remember one thing, which since I have stocks that are in British pence, you need to use the calculator to convert them into dollars. Otherwise the values are quite big here. You're going to have a big discrepancy. You need to convert them into dollars since we are using here only dollars. I hope you guys enjoy these tips, and please let me know if you guys want me to share this spreadsheet. Leave a comment below, and once again, don't forget to subscribe, hit the like button, and thank you, and see you next week. Cheers.